Here's why having less equity in a deal can actually be the smart play. When we raise capital for our commercial real estate deals, our standard offer to investors right now is we give them 19% ownership interest in the deal and then a 10% preferred rate of return on their invested capital. At first glance, some investors might say, wait a second, if I'm putting up all the capital, why don't I get more ownership? It's a fair question, but the answer comes down to risk versus responsibility. And here's why this structure actually protects investors and enhances their returns. Number one, you avoid being a personal guarantor. If you own 20% or more in a deal, most banks require you to personally guarantee the debt. That means if the property ever defaulted, you wouldn't just lose your capital, but you would be on the hook for the entire loan balance. By keeping your ownership below 19%, you're not required to sign on the debt, and your risk is capped at your invested capital. You get the upside without the existential risk of being jointly and severally liable for millions of dollars in debt. And number two, you're protected in a capital call. If a project has turbulence and needs more cash, additional capital must come from the ownership group. With 19% ownership, you're not only responsible for your pro rata share, far less than the principals who control the deal. So instead of being dragged into a never ending money pit, your downside exposure stays limited and predictable. So in closing, looking at the right KPI, IRR, not equity percentage. Equity percentage is a vanity metric. The real question is, what is the internal rate of return? And at the end of the day, sophisticated investors care less about how big their slice is and more about how big the pie grows and whether they're protected if things go wrong.